Have you ever wondered who you're actually doing business with online? I mean, really think about it for a second. Right now, somewhere in the world, a major global bank is extending, I don't know, a $50,000 line of credit to a complete ghost.
Yeah, it's a staggering reality, honestly. We look at the global financial system and we just assume, well, we want to assume, that there is a living, breathing person on the other side of every legitimate transaction.
Right, a real human.
Exactly. But the truth is, we are increasingly doing business with phantoms.
And that is exactly what we are getting into on today's deep dive. We're looking at a stack of incredibly revealing sources today, but primarily we're drawing from this extensive, really fascinating report titled Synthetic Identity, the Manufacture of Financial Credibility.
It is a phenomenal report. Really eye-opening stuff.
It really is. And the mission for this deep dive for you listening at home is to uncover how modern financial criminals have completely evolved. I mean, they aren't just stealing identities anymore, which is bad enough.
No, they've moved way past that.
Right. They are literally manufacturing them from scratch to outsmart the very structural logic of our global financial systems.
Yeah.
And to help us navigate the why and the how behind all this, I'm joined by our resident expert.
Yeah.
And looking at your video feed right now, I have to say the backdrop you've set up today is just absolutely perfect for this.
Ah, thanks. Yeah, I thought it fit the theme pretty well.
It really does. You've got this glowing cityscape, and it's overlaid with these interconnected, shifting digital nodes. It basically looks like this massive network of data points constantly rearranging themselves.
Yeah, and that visual is exactly how we need to frame this entire conversation, because when financial institutions look at you, the listener, they don't see a face. They don't hear a heartbeat.
They just see data.
Precisely. They see a constellation of data points. And criminals, well, they've figured out how to forcefully rearrange those digital nodes to create constellations that look perfectly real to the naked eye, even though there's no actual star at the center holding it all together.
Okay, let's unpack this, because I know most of you listening are already pretty well versed in the headache of traditional identity theft. I mean, we all know the drill, right?
Yeah, unfortunately, most of us do.
Right, a fraudster compromises your real credentials, puts on a mask of your face, and basically goes on a spending spree until you notice the charges and shut it down.
Exactly. It's direct impersonation.
But this report outlines a completely different architecture altogether.
It does. So, traditional identity theft, like you just described, is a one-to-one crime. There is one specific real victim whose life is, temporarily hijacked.
A real person dealing with the fallout.
Right. Synthetic identity, on the other hand, relies on constructing a profile that does not belong wholly to any one individual. It is an entirely new, fabricated persona built from a blend of real and fictitious elements.
It's like a Frankenstein profile.
That is the perfect analogy, yes.
I mean, they are stitching together, say, a real national identification number. And from the report, maybe they scrape a dormant Social Security number from an infant, or maybe an incarcerated person, right?
Yeah, people who aren't actively checking their credit reports.
Exactly. So they take that real number and they combine it with a completely fake name, a borrowed address, and an invented date of birth. But unlike Frankenstein's monster, the seams are completely invisible to the bank software. At a quick glance, the monster just looks like a regular villager.
What's fascinating here is that the report specifically defines this not as a simple onboarding trick, but as a calculated control evasion strategy.
Control evasion. So it's deliberate.
Highly deliberate. This is a highly sophisticated, multi-layered method designed to simultaneously defeat customer due diligence, anti-money laundering controls, or AML and credit underwriting all at once.
All at the same time. Wow.
Yeah, and the most dangerous aspect is how it fundamentally alters the risk dynamic for the institution itself.
Because there is no victim to scream, hey, shut this down. I mean, if someone takes over my actual bank account, I'm going to notice eventually.
You're going to see the money gone.
Exactly. I'll call the fraud department. But if a criminal uses my real zip code, an infant's real ID number, and the totally fake name John Smith to open an account, neither of us knows it happened? There is no single victim to complain that their identity was stolen.
Exactly. It completely neutralizes the financial system's reliance on victim reporting, which is huge. The institution firmly believes they have onboarded a perfectly legitimate, low-risk new customer.
When in reality,
they have just rolled out the red carpet for a criminally controlled profile. It's an artificial customer designed in a lab specifically to survive the bank's exact verification parameters.
Oh, wait, I have to push back on this a little bit.
Yeah.
If the criminal's using an invented name, like, John Smith, attached to an ID number that actually belongs to Jane Doe in the real world, shouldn't a basic computer check catch that mismatch instantly?
You would certainly think so.
I mean, we're talking about institutions with billion-dollar security budgets here. How does this Frankenstein monster actually get past the bank's security guards without raising every alarm in the building?
Well, you'd think the system would catch a name mismatch instantly, and honestly, a decade ago, you'd be right. But fraudsters have figured out how to warm up these data points.
Warm them up.
Yeah. They don't just walk into a Tier 1 global bank and apply for a premium credit card on day one. They exploit the concept of narrow control points by seeding the data in lower-tier systems first.
Okay, what do you mean by seeding the data?
So financial systems verify you by checking external databases, often credit bureaus or public records, to see if your data points corroborate each other.
Like checking if the name matches the number on file.
Right. So the criminal takes this fake name and real ID number and applies for something with very, very low verification standards. Maybe it's a predatory payday loan or just a basic utility service.
Oh, I see. And that low-tier company doesn't check too closely, so they just approve it.
Exactly. They approve it. And the moment they approve it, that fake combination gets reported to the credit bureaus.
Oh, wow. So it becomes real to the system.
It creates what's called a credit header. A new file is essentially born. Now, the fake name and the real ID are officially linked in the database.
That is wild.
So then, 6 months later, when the criminal applies for an account at a major bank, the bank checks the database. And the database says, yes, John Smith is absolutely linked to this ID number.
Because it's just looking at the fake record that was created 6 months ago.
Precisely. The data corroborates itself. The criminals use the financial ecosystem's own interconnected logic against it. The bank checks the street address, it exists. They check the email, it functions. They check the device IP, it's clean. Every narrow control point passes in isolation.
So it's basically like looking at a Hollywood movie set.
That's a great way to put it, yeah.
If you are standing right in front of it and you're looking through the camera's narrow lens, which I guess represents the bank's isolated verification checks, it looks like a real house. I mean, the paint is perfect, the porch looks sturdy, the address is painted right there on the curb.
But if you shift your perspective...
Right, if you walk up and actually open the front door, there's no plumbing, there's no living room, there's literally no history. It's just a two-dimensional facade held up by scaffolding. But the bank is only looking through that narrow lens.
And the weakness really emerges when the institution fails to see that the profile lacks natural human consistency. There is no authentic linkage between its component parts over a lived lifetime.
Because it hasn't actually lived.
Exactly. But because the system checks data in a vacuum, it assumes that because the individual pieces of wood and nails are real, the house itself must be a real home.
Okay, but building the movie set is one thing. A fake house doesn't generate cash. If these profiles are perfectly disguised, what do they actually do once they're inside the vault?
Right, that's the big question.
Because I think most of you listening usually associate financial criminals with, smash and grab tactics.
Yeah.
You steal the credit card, you buy the luxury watches, you disappear overnight.
And that is the defining pivot of synthetic identity. The hallmark of this crime isn't speed, it is immense patience.
Patience. So they aren't rushing.
Not at all. This is not a fast-moving fraud typology. The criminals are playing a very long, very quiet game.
Here's where it gets really interesting. You're telling me that these highly organized crime syndicates are essentially acting like model citizens.
For months, sometimes stretching into years, the report outlines this rigorous maturation process.
So what does that look like day to day?
Well, once the synthetic profile is inside the bank, the criminals interact with the institution in a highly controlled, very low-risk manner. They make small deposits, they set up auto-pay for a $15 streaming service, they conduct regular, unremarkable account activity.
They are farming credibility.
That is exactly what they are doing. They're farming. They might even employ tactics like piggybacking, where they literally pay a broker to add the synthetic identity as an authorized user on a real, legitimate person's seasoned credit card.
Wait, really? People rent out their good credit.
They do. And suddenly, this ghost inherits 5 years of perfect payment history. They use that boosted credit score to apply for a small line of credit, and they exhibit modest, consistent repayment behavior.
Just flying totally under the radar.
Exactly. They are meticulously watering the soil to grow this profile's perceived value over time.
And I imagine this isn't just a victimless crime for the banks. When they finally decide to harvest this credibility they've been farming, what does that look like? What is the actual payoff?
Investigators call it the bust-out phase.
The bust out.
Yeah. Once this ghost has accumulated enough algorithmic trust, the criminal cashes out. In a credit bust-out, they will systematically apply for maximum credit exposures across multiple institutions simultaneously.
So they don't just hit one bank.
No, they hit everyone. Premium credit cards, massive personal loans, high-limit overdrafts. They drain every available dollar of liquidity, and then they simply vanish. The accounts default.
Leaving the banks holding the bag.
Right. And to answer your point about the victim, the bank writes off the loss? Sure. But you and I ultimately pay for it. We pay for it through higher interest rates, increased banking fees, and stricter, much more annoying verification processes when we try to open legitimate accounts.
It's just a massive hidden tax on the entire system. But the report also mentions they don't always bust out for credit, right? Sometimes they use the trusted account for other things.
Correct. Sometimes the real value isn't the credit line at all, it's the trusted transactional history.
How so?
Well, because the account is fully matured and looks like it belongs to an upstanding citizen, it becomes the ultimate vehicle for layering illicit funds.
Ah, I see. Because if a brand new, unverified account suddenly receives a wire transfer of, say, $50,000 from overseas, red flags go up everywhere.
Immediately, the system freezes the funds.
But if an account has been open for 3 years, pays its utility bills on time, and seems totally normal, that same $50,000 wire transfer might just glide right through the system completely unnoticed.
Exactly. It provides the perfect camouflage for money mules or really complex laundering networks. And this patient approach creates an absolute administrative nightmare for the institutions.
Because it crosses so many boundaries.
Yes, because these identities act good for so long, and because they aren't wholly real or wholly fake, they just don't trigger standard fraud algorithms. They sit dangerously at the intersection of multiple departments.
It's basically like a Venn diagram of financial crime.
Oh, totally.
The synthetic identity is sitting right in the middle, hiding in the overlapping gray areas between the bank's siloed teams. I mean, when the bust-out finally happens, the fraud team looks at it and thinks, well, the identity checked out at onboarding, so this must be a credit default.
Right, not our problem.
Exactly. And then the credit team looks at it and thinks, it's just bad luck, the customer fell on hard times. And the AML team doesn't even see the early layering because the transaction volume is intentionally kept just below their detection thresholds.
You've diagnosed the exact structural vulnerability there.
Yeah.
The identity defies traditional classification. It creates transactional pathways that appear completely detached from known high-risk actors.
It's invisible.
Pretty much. When a traditional criminal moves money, they leave a wake. You can track the disruption. When a synthetic identity moves money, it looks like a leaf floating down a stream. It's completely natural.
So if the monster is this good at camouflaging itself, and the damage is this catastrophic across all these different departments, how do institutions actually fight back? I mean, how do you catch a ghost that has spent 3 years proving it's real?
The required operational response is a complete paradigm shift. Institutions must abandon the reliance on pass or fail verification at the point of onboarding and move toward continuous holistic analysis throughout the entire life cycle of the account.
So you can't just check their ID at the door and say you're good.
Exactly. You can't just check their passport at the door and then assume they are safe forever. The report heavily stresses that synthetic identities almost always reveal themselves through behavioral patterns that only emerge after they are inside the system.
Okay, what kind of patterns? If the individual transactions look normal, what gives the ghost away?
You have to look for the invisible tethers. We're looking for signs of external orchestration machinery, basically, rather than ordinary human behavior.
Give me an example.
Well, linked party clusters, for one. Criminals rarely build just one synthetic identity. They automate the process and generate them in massive batches because they are operating at scale or because of software limitations. They get lazy.
Lazy how?
You might find 50 seemingly unrelated customers who all share the same obscure mail drop address, or the exact same device fingerprint, or who all regularly log in from the same block of IP addresses.
Oh, wow. So it's really about network analysis. The individual node looks fine, but when you zoom out and see 50 nodes perfectly synchronized, breathing in and out at the exact same time, that's not human behavior. That's a botnet of bank accounts.
Precisely. You also see unusual application patterns, a cluster of 20 accounts all applying for specific credit products at 3 a.m. on a Sunday.
Right. Normal people don't do that.
Or a sudden coordinated shift in product usage across multiple accounts, like profiles that only ever bought coffee and groceries suddenly on the exact same day start receiving massive wire transfers and dispersing the funds into crypto exchanges.
But to catch that synchronized breathing, to see that whole network, those siloed departments we talked about earlier have to actually talk to each other.
This raises an important question about institutional governance, which the report highlights as a really critical point of failure. Managing this risk requires ruthlessly breaking down organizational silos.
They have to share data.
They have to. Synthetic identity must be explicitly featured in holistic risk assessments. The onboarding team needs to share their initial device data with the continuous transaction monitoring team, who needs to share their behavioral alerts with the credit risk team.
It all has to connect.
Right. If an identity barely scrapes by the onboarding controls and then generates subtle, seemingly minor concerns in the credit department, those dots have to be connected.
It requires an entirely different mindset from the investigators too, doesn't it?
It does. For decades, fraud teams have been trained to ask one very binary question. Is this ID real or fake?
Right. And with synthetic identity, the answer is, well, the social security number is real, but the name is fake, so both.
Exactly. Binary thinking completely fails here. The more demanding but absolutely necessary standard is shifting the question entirely. Investigators must ask, is this identity authentic?
Authentic, not just real.
Right. Is it attributable to a real and rightful individual, and is the behavior we are seeing consistent with that claimed existence?
So it's basically the difference between looking at a photograph and watching a movie.
Oh, I like that. Expand on that.
Well, a photograph can be easily faked to look perfect in one static moment, right? That's the onboarding check. You see a picture, it looks good. But a movie requires consistency over time. A lived life has a messy, continuous timeline. It has natural unpredictability.
That's a great point.
An assembled life is just too perfect, too sterile. And eventually, if you watch the movie long enough, the boom mic drops into the frame.
That is exactly it. Finding those slip-ups requires deep cross-element verification and behavioral analysis. It requires a willingness to challenge an identity even when the individual data fields appear technically valid in the system.
Which is hard for a bank to do.
Very hard. But if the identity evidence is unusually thin for someone supposedly 35 years old, or if it was recently created out of nowhere, or if it is contextually weak, the institution has to dig deeper. It is entirely about determining whether the identity presented makes natural sense across the wider relationship.
So what does this all mean? If we pull all these threads together, what is the ultimate takeaway for you, the listener, today? It seems pretty clear that synthetic identity is the ultimate manufacturer of credibility.
It truly is.
Criminals have looked at the financial system's structural logic, its absolute reliance on matching isolated data points, and they have weaponized that logic against the banks. They are building perfect, two-dimensional facades. And stopping this threat requires a massive evolution in how we view identity itself. We have to move from simply checking data to verifying authentic human coherence. We have to look for the heartbeat, not just the paperwork.
The challenge is no longer limited to confirming that data points simply exist in a database. But, if we connect this to the broader trajectory of technology, it leaves us with a rather chilling thought to consider moving forward.
Uh-oh, what's that?
Well, we've talked today about the immense patience and manual orchestration required for a criminal syndicate to build a lived synthetic history over months or years.
Right, the farming process.
But what happens tomorrow? What happens when criminals start utilizing advanced generative AI to automate this entire ecosystem?
Oh, wow.
Imagine them generating not just a single synthetic profile or a batch of 50 lazy accounts, but entire synthetic networks, whole fake families, fake employers, and fake communities that all digitally interact, endorse, and verify one another in real time.
Just creating an airtight illusion of reality.
Exactly. How will our financial systems possibly tell the difference between an assembled life and an assembled society?
Wow. An assembled society. A whole network of ghosts actively validating each other's existence. That is a terrifying but honestly incredibly important question to leave off on. Because as the technology scales, the definition of what makes us real in the digital world is only going to get blurrier.
It definitely is.
Thank you for joining us on this deep dive into the synthetic shadows of the financial system. Keep questioning what you see, stay vigilant, and most importantly, stay curious. We'll catch you on the next one.